Hey everyone, Alex here, and today we're diving into the top 5 simple investing mistakes that might secretly be draining your bank account, and exactly how to fix them. Believe me, you're probably making at least one of these mistakes without even realizing it, and the money you're leaving on the table could seriously surprise you. So, what's the number one investing mistake even experienced investors often fall victim to? It's chasing hot trends. You know exactly what I'm talking about. The flashy new stock everyone's buzzing about, the crypto coin that's supposedly going to the moon, or that new ETF that's making headlines. The thrill of jumping onto something that's soaring feels incredible, until it suddenly crashes and wipes out your profits. But how do you avoid the emotional roller coaster and still capitalize on market opportunities? Keep watching because the solution is simpler than you think. The smartest investors don't chase the latest fad. They stick to their long-term strategy, focusing on companies and funds that consistently deliver solid performance over time. Warren Buffett himself famously avoids trendy investments and instead prioritizes stable, profitable businesses. This approach might sound boring, but boring investing can actually be incredibly profitable. Think about this. Would you rather have short-lived excitement or consistent wealth building? But here's the twist. Avoiding trends doesn't mean ignoring innovation entirely. So, how do you strike the right balance between playing it safe and staying ahead of the curve? We'll reveal that shortly, but first let's tackle another big mistake that's secretly sabotaging your investment returns. Mistake number 2 is neglecting diversification. You've heard it before? Don't put all your eggs in one basket. But let's be honest, how many of you are actually spreading your investments effectively? Putting too much money into one stock, sector, or asset class is risky. If that single investment stumbles, your entire portfolio can crash hard. So, what's the best way to diversify without diluting your potential for great returns? The answer is building a portfolio across multiple sectors, regions, and asset classes, including stocks, bonds, real estate, and even some alternative investments. By diversifying, you protect yourself against significant losses in any one area and benefit from gains across multiple sectors. Remember, the goal is stability and consistent returns, not gambling everything on one winner. Now, here's mistake number 3, and this one might surprise you because it seems counterintuitive: checking your portfolio too often. Wait, what? Isn't staying informed a good thing? Actually, obsessively checking your investments every single day, or worse, multiple times a day, can be harmful. Why? Because markets naturally fluctuate, and reacting impulsively to every minor change can lead to costly decisions, like panic selling or impulsive buying. But how do you stay informed without driving yourself crazy and hurting your returns? It's simpler than you might think, and I'll share a practical, stress-free solution in just a minute. Mistake number 4, and this one is a big one, is timing the market. Trying to predict exactly when to buy low and sell high sounds smart, but guess what? Even the most experienced financial experts struggle with it. Studies have repeatedly shown that investors who consistently try to time the market end up earning significantly less than those who simply invest steadily over time. Instead, the smart approach is called dollar cost averaging. This means consistently investing a set amount at regular intervals, regardless of whether the market is up or down. Over time, this averages out your purchase prices, reducing your risk and increasing your returns. This approach is proven to outperform market timing in almost every scenario. But now, the million-dollar question: how do you apply dollar cost averaging in a way that's easy, automatic, and incredibly effective? I'll give you the exact steps shortly, but before we get there, we've still got one more crucial investing mistake you absolutely need to avoid. The 5th simple investing mistake, and honestly, this one might be the costliest of all, is ignoring fees. You might be shocked to learn just how much fees can eat away at your returns. Even seemingly small fees like 1 or 2% can cost you tens of thousands of dollars over the long run. Imagine that money in your pocket instead of your broker's. But here's the good news: reducing fees is easier than you might realize. Curious how you can drastically lower your investment fees and keep more of your hard-earned money? I'll show you exactly how in just a moment, plus reveal the incredibly simple fixes to all these costly mistakes. Ready to finally stop losing money and start building wealth more effectively? Let's dive into exactly how to correct each of these costly mistakes, starting right now. Mistake number 1, chasing hot trends, is best fixed by establishing clear investment rules for yourself. Before investing, set strict guidelines about the types of assets you'll consider and commit to them. For example, focus 80% of your portfolio on well-established companies or reliable index funds, and only allow 20% to be allocated towards speculative opportunities. This lets you responsibly explore new trends without jeopardizing your long-term wealth. But how about diversification? Remember, diversifying isn't about randomly buying different stocks. It's about strategic balance. Aim to include a mixture of stocks, bonds, index funds, and even assets like real estate. A simple yet powerful strategy is the 60-30-10 rule. 60% in stable stocks or index funds, 30% in bonds or fixed income investments, and 10% in growth or speculative opportunities. By maintaining this ratio, your portfolio becomes resilient and optimized for steady growth. Now let's tackle the anxiety caused by obsessively checking your portfolio. Here's a powerful but simple fix. Schedule a specific day each month to review your investments. Mark your calendar and strictly avoid checking your portfolio outside of that scheduled day. By doing this, you'll protect yourself from emotionally driven decisions caused by daily market swings, allowing your investments to grow without unnecessary stress. So, how exactly do you stop trying to time the market? The answer is simple. Automate your investments through dollar-cost averaging. Set up automatic transfers into your investment account each month, regardless of market conditions. This way, you're buying consistently at various price levels without worrying about timing. Research shows that consistent investing outperforms nearly all market timing strategies in the long run. By automating, you eliminate emotions and stick to the proven path of steady wealth accumulation. Finally, let's fix the sneakiest mistake of them all: high investment fees. To lower fees, start by investing in low-cost index funds or ETFs, rather than actively managed funds, which typically carry higher fees and rarely outperform the market long-term. Additionally, regularly review your brokerage statements to identify hidden or unnecessary fees and switch to platforms offering transparent pricing with zero commissions. By simply cutting fees by even 1%, you can significantly boost your long-term returns. Implement these simple fixes today, and you'll dramatically increase your financial success without unnecessary risk or stress. Investing doesn't need to be complicated. Avoiding these common mistakes puts you miles ahead of the average investor. If you found these tips valuable, make sure to share this video and help others grow their wealth too. Until next time, happy investing!